The Defensive Investor in the Common Stocks by Benjamin Graham. The investment merits of common stocks. In our first edition, we found it's necessary at the point to insert a long exposure the case for including a substantial stock component in all the investment portfolios. The common stock were generally viewed as the high speculative and therefore unsafe. They have declined fairly substantially from the high level of 1946, but instead of attracting investors to them because of the reasonable price, this fall has been opposite effect of undermining confidence in equality scenarios. We have commented on the converse situation that has developed in the ensuing 20 years, whereby the big advantage of stock prices made them appear as safe and profitable in the investments of higher record high level, which might actually carry on with a considerable degree of risk. Argument we made a common stock is 1949 tuned on two main points. The first one is they have offered a considerable degree of protection against the erosion of inversion dollars caused by the inflation, whereas a bond feared no protection at all. The second advantage is common stocks they lays in the higher average down into investor over the years. This was produced both by the average dividend income preceding the yield on the good bonds and thereby underlying tendency of market value of increasing the years, consequence of the reinvestment in undistributed profit. While there are two advantages has been major important, we have given common stocks a far better record than the bonds over a long term past. We have consistently warned that the benefit could be lost by the stocks buyer if he buys too high at a price for his shares. Clearly, the case of 1999 and it took 25 years for the market level to climb back to the ledge for which it is absurdly fallen in 1929 and 1932. Since 1957, common stocks have come once again through the high basis, lost a traditional advantage in the dividend yield over the bond interest rates. It remains to be seen whether it is an inflation factor or an economic growth factor which made up the future of the significantly adverse development. It should be evident to the reader that we have enthusiastic for common stocks. For generally in 900 DJI, the level of 1971 for a reason already given, we feel that the defensive investor cannot afford to be gay without the appreciable proportion to common stocks in the portfolio, even if he must regard them as a lesser two evils. The greater being is a risk attracted to the all bondholder. Rules of common stock component. A selection of common stocks or portfolio to a defensive investor should be relatively simple matter. There we should suggest four rules are followed. There should be adequate through not excessive diversification. That means a minimum 10 different issues and maximum about 30. Each company select should be large, prominent, and conservatively financed. Indefinitely as an adjective must be a gentle sense of clear observation on the point added to the end of the chapter. Each company should have a long record of continuous dividend payment. All the issues of the Dow Jones Industries average meet the dividend requirement 1971. To be specific to the point, we should suggest the requirement of continuous dividend payout payment beginning at the least 1950. The investor should impose some limitation on the practice. He may pay the issue in relation to the average earning overseas. The past 7 years, he suggests that the limit to be set by 25 times the average earning on or not more than 20 times. These are the last 12 months period. But such a restriction would be eliminated nearly all the strong and most popular companies for the portfolio. In particular, he would ban virtually the entire category of growth stock, which have some years past has been favorites of both speculator and institutional investors. We must give now the reason for popping are so drastic and exclusive. The growth stocks are defensive investors. The term growth stock is applied to one which is increased per share, earning in the past as well above the rate of common stock generally, and expected to continue to do so in the future. Such some authorities would have that a true growth stock should be expected at the least double per share earning in 10 years. That has increased them in the compound annual rate of 7.1%. Obviously, stocks of the kind are attracted to buy and to own, provided that the price is not exclusive. The problem lies there, the cost, since the growth stocks has been sold at the high price in relation to the current earning and at the higher multiples of the average profit over the past period. This has introduced a speculative element of considerable weight in the high stock price, and they may successfully operational in the field of R of simple matter. The leading growth is a high being international business machine, and it has brought phenomenal reward to those who bought the years also. I held on the intentionally, but we have already pointed out that the best common stock actually lost 50% of the market share in 6 months, declined in 1961 1962, and nearly the same person 1969 70. After the growth stock has been even more vulnerable and adverse development in some cases, not only as a price fallen for the earning well. That's the cause of double discomfiture to those who own them. The good second example, the purpose of Texas Instrument, which is a 6 rows from 5 to 5 without paying a dividend, while earning increased by 40 to 3.91% per share. Note that the price advance of 5 times at the fast as the profit. This characteristics of the popular common stock, but 2 years later in the earning has dropped off nearly 50% of the price for 452 44 50 to 49. The reader will understand that for this instance, which regards given a stock to the whole to uncertain the risk of a vehicles for the defensive investor, for which wonders of the accumulated with the right individual selection, bought up by the right level and later sold after the high rise before the probable decline. But the adverse investor can no more expect to accomplish this than the find a money growth on this. In contrast, we think that the group large companies that are relatively unpopular, therefore obtainable at a reasonable earning multiplier, offer a sound in unspeculated area by choice of general public. We shall illustrate the idea on a chapter and portfolio section. Portfolio changes. It is now standard practice to submit all security list of periodic inspection in order to see whether the quality has been improved. This is a cause of major point or major part of the service provider of client by the investor consultant. Nearby all the brokerage houses are ready to make corresponding suggestion without the special fees. In return for the commission business involved, some broker business maintain investment services on the free basis. Presumably on the defective investor should be obtained at least a year some kind of advice regarding changes in the portfolio as for when the funds are first committed. Since we will have little expertise for the own on which is ready, it is essentially interest themselves on tools and highly reputable. Otherwise, it's many easily fall into the incompatible or the scrupulous hand. It is important in our case that every other consultant here make clear to advise the wish to adhere closely to 4 rules of common stock selection given earlier in the chapter. Incidentally, if the list has been completely selected in the first instance, there should be no need of frequently number changes. Dollar cost average. New York Stock Exchange has put a considerable effort to popularize the monthly purchase plan under which the investor devote the same dollar amount each month to buy a more common stock. This is the application of a special type of formula investor known as a dollar cost in advising and averaging. During the predominantly rising market experience since 1949, the result from such procedures was certainly high satisfaction, especially since they prevented the particularly from practitioner from concentrating his buying to the wrong items. The Lucien Tom Linson comprehensive study of formula investment plans, the author presented a calculation of the result of dollar cost average in the growth of the common stocks making the Dow Jones Industry Index. The texts were made covering the 23 10-year purchase period. The first ending of 1929, the last ending is 19 52, every test showed the profit either at the close of the purchase period or within 5 years thereof. The average indicator profit is the end of 23 buying period of 21.5%, inclusive of dividend received. Needless to say, some of the instances there are substantial temporary depreciation in the market value. Miss Tomlinson ends his discussion in this under simple investment formula with a striking sentence: "No one has yet discovered other formula for investing which can be used within some so much confidence of ultimate successor." Regarding of what may it happen to security prices or dollar cost averaging. It may be objective that the dollar cost averaging would sound impractical, the rather unrealistic the practice, because a few people are so situated that can have available for the common stock investment the same amount of money every year for the 20 years. It seems mean that apparently the lost much for recent years. The common stocks are becoming generally completed the general component of the sound saving investment program. Thus, a systematic uniform purchase of common stocks may present no such psychological and financial difficulties that similar continuous payment of United States savings bond and the life insurance, to which they are such complementary. The monthly amount may be the same, but the result after 20 and more years can be preserved in the important saver. The investor personal situation. At the beginning of the chapter, we referred the brief position of individual portfolio owner. Let us return to the matter to the insight of a subsequent discussion of general policy. To what extent would be the type of securities selected by the investor varying in circumstances. A concrete example of a representative wide different condition, we shall take a window of left 2 lakhs, which is supposed to be herself financial run. A successful doctor is mid-career with savings of $1 lakh and yearly accession of 10,000, and the young person earning 200 per week and year saving 1,000 a year. For this widow, the problem of the living is has a income is very difficult one. On the other hand, the need for conservation and consistent investment is paramount. A division of the fund about equal between the United States bond and the first grade common stock is uncompromisable between the objective and corresponding to a general personification of defective investor. The stock component must be placed on a high of 75% of investor in psychologically prepared for the decision, and if she can be almost certain she is not buying a too high at level, and assure this is not the same in early 1972. We do not preclude the possibility that widow may qualify as an enterprising investor, in which cause objective was method will be quite different. The one thing the widow must not do is to take speculative changes in order to make some extra income, but this is mean trying the profit or high income without necessary equipment to warrant a full confidence in the overall success. It would be far better for her to draw 2,000 per year out of her principal in order to make both in meet. That as a result, half are poorly grounded and therefore speculative ventures. The prospectus doctor has more none of this window pressing and compulsion, yet will believe that the choice are pretty much the same. If he is willing to take a serious interest in the business of investment, if he lacks of impulse or flair, he will do the best and accept the easy role of adverse investment. The division of the portfolio would be no different from that of typical window. There would be a same area of personal choice of fixing the size of stock compound. The annual saving would be invested in about the same proportion as to the total funds. The average doctor may be more likely than the average window to elect and to become the enterprising investor, and he is perhaps more likely to success in the understanding. He have one important handicap, however, the fact that he is less available to give to the investment education to the administration in his fund. In fact, the medical men have been notoriously unsuccessful in the security dealing. The reason for this is that usually having an ample confidence in their own intelligence and strong desire to make the good return on their money, which how the new realized that they to do so successful requires both considerable attention to the matter and sometimes it is a professional approach to security values. Finally, the young man who saves $1,000 a year is expected to do better gradually, find himself with the same choices, though for a still different reason. Some of the savings should be automatically into the series of e-bonds, and the balance is modest to the seems hardly worthwhile for undergoing the tough education and temperamental discipline in order to qualify as an agreed investor. There's a simple sort of to our standard program for the defensive investor would be once easier for the most logical way. Let us ignore the human nature at the point. Finance as a fascinating for many bright young people with limited means. They would like they would like to be both intelligent and enterprising in the placement and having savings, even though investment comes much less important to them than their salaries. This is attitudes all the goods. There is a great advantages of the young capitalist to begin the financial education and experience. If he is going to operate aggressively, investor and certain to make many mistakes and to make losses, the youth can stand this disappointment and profit by them. He urged the beginner to security buying not to waste his effort and his money in trying to beat the market. Let him study the security values and initially list test out the judgment and price versus value within the smallest portionable sum. As a return of standard made by the outside, the kind of security to be purchased, the rate of return to be short, and not the investor financial resources on the financial equipment, terms of knowledge, experience, and temperament. No, the concept of risk. It is conventional to speak of good bonds as a less risky than the good preferred stock and of the later and less risky than the good common stocks. For this was received the popular prejudice against the common stocks because they are not safe, which is demonstrated in the Federal Reserve Bank Board Survey 1948. We should like to point out that the good risk and the safety are applied to securities two different senses, which result in confused in though the bond is clearly proved unsafe to when it is difficult to interest or a difficult principal payment. Similarly, if a preferred stocks or even a common stocks is bought within the expectation that a given rate of dividend will be continued, then the reduction or passing and dividend means it will be proved unsafe. It is also true that the investment contains a risk if there is a fair possibility that holder may have to sell at the time when the price is well below. Nevertheless, the idea of the risk was often exhausted to apply to the possible decline in the price of security, even though the decline may be cycle and temporary nature, and even though the holder is unlikely to be forced to sell at such times. These changes are present in all securities and other United States savings bond. It is to greater extent the general run of common stocks than senior issues of the class, but we believe that this is the best involved, not the true risk in the true useful sense of term. The man who holds a mortgage a building might have been taken substantial loss if he were forced to sell the unfavorable times. And this element is not taken into the account of judging a safety, not a risk coordinated real estate mortgage. The only criteria being an certain punctual payment. In the same way, the risk attracted in ordinary commercial business is measured by the chance of losing money, not by what happened if the owner were forced to sell. Chapter 8. We shall set about a conviction that the bona fide investor does not lose the money merely because of the market price of holding declines. Hence, the fact that decline may occur does not mean that he is running a true risk of loss. If a group of well selected common stock investment shows a satisfactory overall return as a measure through a fair number of years, then the group investor has proved the safe during the period of market values as bond fluctuated, and likely to not it will be sealed while under the buyer's cost. If the fact makes an investment risky, it would then be called both risky and safe at the same time. The confusion may be avoidable if we apply the concept of risk solely to the loss of value, which either is realized through the actual sale or caused by the significantly deterioration of the company's position, or more frequently perhaps is a result of payment of excessive price relation to the intrinsic value worth of security. Both the common stocks too involves a risk too of such deterioration. But in our thesis that the probable executed group's investment is a common stock does not carry any substantial risk of the sort, and that though therefore it would not be termed risky mere because of the element price fluctuation. But such a risk is presented if there is a danger that is a price may prove to have been clearly too high for intrinsic value standards. Even it may substandard serves market decline, but recouped many years later. Note the category large, prominent, and conventional financial corporations. The quarter phase is captured or used earlier in chapter to describe the kind of common stock to which defensive investors should limit the purchase. Proved also that they had paid continuously dividend for a considerable number of years. The criterion based on the adjectives always ambiguous, where it is dividing a line for size for prominent or conversion of financial structure. On the last point, we are suggested to specify standard there, though arbitrary, in the line of accepting things. An industrial company finances not conservative unless a common stock represent at least half of the total capitalization, including the bank debt. For the railroad, publicity of the figure should be at least 30%. The word large and prominent may carry the notion of substantial size combined with the leading position in the industry. Such companies are often referred to the primary, all about the common stocks, or this called secondary. Expect that the growth stocks are ordinary place in the separate class of those who buy them as such. To supply the element of concreteness here, let us like a significant let us suggest that the present day terms, a company should have 50 million of assets or 50 million of business. Again, to do a prominent, a company should rank among the first quarter, the first third in the size within the industry group. It must be foolish, however, to insist upon the arbitrage criteria. They often merely guide to those who may ask the guidance. But as a rule that an investor may set there himself and which does not violate the common sense of meaning. Large and prominent would be acceptable by the value where our nature of these, which may be large groups of companies, and same will be others will not be included among the suitable of defensive investor. There is no harm such diversity of opinion action. In fact, it is a statutory effect upon the market share market condition because it permitted a gradual differentiation and transition between the categories of primarily and secondary stocks. Sure. Commentary. The line is drawn in the stand it and that is if an asset has a cash flow and likelihood of cash flow in the near term, it's not purely dependent on what the future buyer might pay. It is an investment. It is asset value of total dependent on the amount of future buyers might pay. Then the purchase is a speculation. The defective investor or a gram note that chapter 4 wants a minimize the time and effort that investing taking wants a freedom from the concern. The stock market isn't your only concern though. You face two great external danger as to defense investor. First, you need to fend out the brokerage industry because the defense investor are almost near trade. They generate no revenue for brokerage firms. That is called the democratization of investing. The low cost trading for anyone who has smartphone with brokerage app is a compelling delusion. It is sound empowering, but it is not transferring defensive investor into hyperactive traders who make the brokers risk. You also need to defend against social contrage condition. Once you let other people to do your thinking for you, your single most valuable asset, your intellectual intelligence is impaired. And once you lose part of the senses of self and losing financial wealth, you won't be far behind. By the time you recognize your lost ability to think for yourself, it will be too late. Gamification or gamification. The companies begin trading apps or E-True, Robinhood, a Tasty Trade, Wellbull often describe them as a gamification, but gamification would be more accurate. We shouldn't liken trading app to the game. They can make an education, fitness, dieting, and other activities more engaging and achievable. We should satisfy them as a poker, casio, sports bet, tapping, and gambling machines that exploit the vulnerable users and addict many of them. Gamification investing tools is a fun to use, but it is three in insidious feature. The designing is to encourage a short-term trading. It is a potential addiction as to relies on the manipulative techniques perfected by the gambling industries. Among three, the bright energy audio visual display that make the stock price resemble spinning reel and the slot machine highlighting the changes of your wealth, not the amount of your wealth. It is a scratching of rewards resembling a lottery ticket gives you share of random stocks when you first to sign up, and excitement of playing with what feels a free like a free money frequently alert notification you big moves and goading your trade. The badges and trophies and level silver gold platinum gets you a competitive juice flowing. Like a hottest and most popular stocks, copying and like is which you was a mimic and parase your people treats as they were yours. A leadership board shows who were making the most money. Amplifying apps who goes user with the trading options and contract which is more riskier generate the higher brokerage fees. Casinos are designed to maximize the operating call of TOD, a time on advice, and this allows the spend as a friend on slot machine. The more certain you are or to lose, you would immediately walk away if you hit the jackpot. But casinos are known to glue you to your seat with an hyponic audio visual and mono nano monetization. The ability to place many small bets simultaneously. Amplified brokerage apps to follow the same principle of maximizing TOD. In 2020, while testing the Robinhood temporarily because of a trading direct myself, a study of the on direct security commission found that the earning reward promoted people to trade 39% more often. Seeing the weekly list of top trading stocks led to participants to increase their trading to same record of 14%. The simplified brokerage app to adding badges, level, and leadership. We also change how it is investor think. Instead of seeing to fulfill their own financial goals, they will instantly strike best ever born else. Becoming up to the twice as likely to buy a high risk stock. Faster you run, behind you get. The faster trading encourage the brokerage apps provide a short-term fun and long-term losses among more than 66,000 US household using a major discount brokerage. Those who trade the most underperformed those who trade the least by more than 7 percentage point annually. Study roughly 22,000 retail brokers consumers in the Brazil found that among the who kept making short-term traders for the least 300 days, 97% money they lost. A few was fewer than 3% are active traders in the Taiwan on a profit. Although most can't stop trading, people with a history of losing money generate 75% total trading. Contract of difference CFDs are popular way of placing a long-term, short-term bets. Their asset price will move up in the market. On average, 74 to 89% of the consumer who trade CFD lose money. The stock market should be what economics call the positives come game. Companies grow their increasing earning, generate dividends, and the rising stock prices, and enabling investor to build wealth. If you gamble instead of investing, however, you turn the stock market into a negative some money. You miss out the recapping reward of long-term ownership, creating unnecessary trading costs, and generate punitive tax bills. And instead of going along with the trade, you get token by the ride. It's the gamification education. Proponent of gamifying brokerage have defined them with an argument as making investing fun is a great way to get a young people to try it. Even if they lose money at first, you have to take a risk of learn how to manage them. You should an inexperienced investor have to behave dangerously to learn how to behave safely. We don't get age to drink responsibility by challenging them the chunk down. 50 shots of whiskey. We don't instruct your young people how to drive by urging them to crash cars into brick walls at the 100 100 kilometer per hour. And no, do not teach fireman safety by having no device, taking target practice by blasting shotguns at their own feet. Gamblified brokerage apps that encourage impossible people to practice dangerous investing behavior are terrible, if not tragic training for life. The wisdom of crowds. If it can seem rational to join the herd, our everyday experience and our revelatory history teaches us teaches us how, as the crowd is often correct. You probably wouldn't eat at the complete empty restaurant, purchase a product that has no positive online review, or buy a house that no one else want to bid on. Learning from other people facilitates cooperation, collective problem solving, grouping often not more than one person does. Also, it feels safer inside the herd. We also want to be popular, belonging to the in growth. The bigger the group we belong to, the most compelling, the irresistible the message we feel. The size of the online crowd has no physical constraint. Million can join own and shoring stock that you can chat about online with thousands of other people who all love it, and you will feel you belong to the pride of the lions. Owning to a falling stock that nobody wants to touch, and you will feel that stunk of garden party. What's more, if you are acting alone and making a mistake, you have no one to blame but yourself. If you go although with the crowd, it turns out to be wrong, you can shrug and say everybody else go wrong too. Finally, a crowd make things happen. Starting 2022, swan of investor cold selling of Reddit, Twitters, and Discord began to pooling buying power and drive up the prices of this favorite stock. AMC Entertainment holding GameStop, Bed Bath Beyond, and many more leaders are barely bidders who profit hundreds of times larger than that they put in. By channeling the bias power of millions of small investors into the tiny number of stocks, they created the giant force that could send and company share soaring just by mentioning it. And anyone could go through this right. They are not just the fun madness of crowd. Yet crowds aren't always right, and errors or contagious. That can be claustrophobic, and when a million of people fall under the spell of murders, rabblos, will like Hitler's and Mussolini, or it can be insiders as the conspiracy theories became the mental epidemics when the baseline beliefs almost investing should go over it. The separates a wisdom from the madness of crowd. 1909, the situation of Francis Galton described the result of content of agriculture fair that nearly 800 visitors tried to gauge the weight of ox. Although many of them know little nothing about the oxen, and then cases varied widely, and visitors' average estimate turned out to be exact weight of the ox. The Francis Galton guessers have variety of viewpoints. So to win a prize for the most accurate guess doesn't know how other people estimate and had to pay a entry fee. The sponsors of this contest collected all the guesses and tallied them fairly. The judgment of the crowd were independent, confident, and diverse in devised and aggregate and therefore remarkable accurate and estimate simple values. Today, a financial market, online and social media mobs, see the with emotion, but variable information is scary. Predictions are made in the public within countless strange trying to influence other people's opinion. Popularly influencers set off the stampers, crunching cognitive diversity of million of people rushing to impose the same belief. There are no barrels to entry and no barrels to entry, and no easy way to authorize the claims of expertise, and no register to follow, calculate, and how extreme the opponents are. All too often, the judgments of the sort of a crowd are opposite for a Galton dependent public homogenized, non-incentivized and disagreed, that can turn the wisdom of the crowd into madness. The weight of the horse doesn't change with people estimate of it. However, if the million speculators suddenly decide that the stock is worth $100,000, it will skyrocket at the least temporary, even it is worthless. The herd of street learning from the other people, thinking thing changes how you think. When you find out that the group of your peers agrees with you, your choice becomes three times more likely to match theirs, although you will have no conscious awareness being influenced. A single exposes opinion of somewhat desire of expert enhance your memory from the information, how favorable you view it, and agreeing with your peers with them purpose exports will activate some region of your brain that process the anticipatory of rewards. This information becomes more complex and ambiguous. You became more prone to interrupt in the same way the crowd does. The social media by design amplifies a view of resemble your own recent study found the investor on social media 5 times more likely to follow users to agree with them and will see nearly 3 times the mere messages they urged with them disagree with. Falling into the kind of each echo chamber, the study showed that lead people to trade more and earn lower trade returns. The more people like a pass of social media, higher the odds that you will like it well. Liking the post already liked by lots of other people, activities, and key reward centers in the human brains more intensely than liking the lost popular post. On public brokerage platforms, having other people's like your trades will lead you to trade 3 times more often than those who had received such feedback. Meanwhile, the bunking of consequence engaging circuits in the brain that generates pain, that generates fear, generates anxiety, and disgust. If you are even rooted against the home team's crowded stadium and spoken up for your candidate in a room full of members of the opposition political party, you know how hard it will feel not to fit in. Large the group, the more painful standing alone becomes. Worse, the algorithm embedded the social media platform like Facebook, Twitter, TikTok appears to be designed to maximize the time you spent on the device. They do what they fixing your attention on the celebrities, on the people who agree with you, on the information of imagination and inflame your emotion. They make certain content seems more prevalent. That is that they must persuade that it should be. Those algorithms are invisible but pervasive forceful that pull you away from thinking for yourself. Vaccination yourself against the contagion because you may never realize how much groups have influenced your behavior issues. It is then vital to protect you before you join the crowd. First, don't join the group that difficult or different value. You should marry your investments and not spearhead them and associate with the people who trade promiscuously and bound with the infect your behavior. Seek our patients like a like-minded investor on such line command you like Bogleyhead.org, human.com, mutualfundobserver.com, valleyinvestorclub.com. Look for the for posts that steer clear hot takes and the latest headlines. Avoid danger, boasting, and mockery, and revealing the source and reveal the sources like linking to long-term data and peer reviewer research rather than such makes assertion without evidence. If you have a view about the search or investing strategies, write it down your reason for the belief because you're exploring that some online group is saying there is no action without reviewing your original rationale, determining that there is a reasonable basis for changing ground in data and evidence, not just opinion of random people online. Remember that internet and social media reality distortion field. Likes and upvotes go to the loudest and bearish advice, not the best. The conflict of interest but are often dislocated. Automated bots skewed with the post gets the most attention. Paradoxically, the more exposed people have, the more often they will see. I don't know. It's depend letting them to sound. If they know less than those who often change or wrong, but never it down. The one who admit the limits of knowledge on the ones to listen to. But an investing in show. The succeed as an defensive investor, you must be able to turn your back on the crowd. Otherwise, you will run the risk of almost constantly overreacting the news and opinion rumor. Don't speculate, automate. With a dollar cost averaging, you can invest a fixing amount of money at a predetermined interval every month, every week, every quarter, every year, whenever you can, whatever you can. Your brokerage or your fund company will automatically move the money from your bank into the electronic transfer, so you don't have to lift a finger. Many corporate retirement plans and government pension system do this for you, but using additional money of your own is another way to impose and discipline on yourself rather than jumping in or out of market giant leaps, because become an inchworm steadily, adding more and more matter of the market does, such as automatically investment plan can't guarantee you won't lose money, but it is complete you to keep investing even when the stock market is crashing, and it is preventing you from having money infused into the market when stocks are soaring. This automated purchase are not out of sight, out of mind, or you aren't making frequent ad hoc decisions that you will success in regard later. By dollar cost averaging a simple basket of index fund and trading only to rebalance, you can put your entire portfolio at multiple level of autopilot. The Graham wrote about the dollar cost averaging in 1962. Such as a policy will pay out ultimately regardless of when it is begin, provided that it is an adverse to conscientiously and courageously under all the intervening condition. This is the purpose of the dollar cost average and will not be subject to the alternative acceleration and deep gloom that has been accumulated by the guide generation of stock market for generation past. In a speech of next year, he added, "The way you buy more shares of stocks when the market level is low and fewer shares than its high, the matter has worked out extremely well for those who has the money entire time characteristic necessary to pursue consistently policy over the recent years regarding whether the market has been become going up and down. If you can do that, you guarantee satisfy success in your investment rather than following the herd. Follow the Graham policy. It is a short run you will miss out the little fun, and the long run you will build a lot of more wealth.